Video, I will talk about standalone long-term care insurance and some of the hiccups that have come up in the long-term care industry over the years. If we haven't met, my name is John Burbank and I work at the Lyman Group. We are a 51-year-old relationship-focused financial services firm located in Seattle, and we help successful individuals, families, and businesses find tax-favorable strategies to grow their money for retirement, and they can use that money for a host of applications, all the while they're protecting their risk during their income-producing years. Most of our strategies are not very common with the general public, so I'm very excited to continue to bring these to you. And before I get started today, I would like to mention that I am monitoring the comment section. So if you do have any questions, comments, or a story that relates to what I'm talking about, I would love to hear from you. And if you have a friend or family member who would benefit from this information, please tag them in the comment section with the at sign before their name. And mainly because the whole purpose of these videos is to educate you, the general public, on what we know. We have a lot of information and we really just want to get it out there and get you guys educated. If you'd like to know more about what we do, please visit our webpage at thelymangroup.com. And one last thing, if you're watching this after the live broadcast and you still have a question or comment or want to get in contact with us, we do monitor the comment section each week. So go ahead and leave something and we'll make sure to get back to you as well. So, standalone long-term care insurance in America. It's been an interesting road. It's been a bumpy road for long-term care insurance here in America. So with life expectancies spiraling out of control in the right direction, long-term care insurance makes more sense for more people every day. Without it, you're left with three not very favorable options. One is you can self-fund your long-term care needs, and that's going to be a dollar for dollar situation for your medical bills, and that's very expensive. Two, you can become poor enough to qualify for Medicaid, and that's very emotionally taxing on your people, and it's also very difficult to do, especially when you need long-term care because your facilities are not in a position to take care of the sale and make sure you get full value for your assets. And the third option is you look to a loved one or a family member to take care of you during your long-term care needs. And that's also very expensive, not only because they're putting off their profession, but they're sacrificing their social life, and you yourself probably don't feel too good if you have to rely on someone you love to put off their life to take care of you. And so long-term care insurance came about to be the most cost-effective way to take care of one's long-term care funding needs compared to these three options. However, the long-term care industry has been on a roller coaster since the 1970s. The original policies were not perfect, and it took until the mid-80s and early 90s for the long-term care industry to really gain traction in America. When the standalone long-term care insurance policies were introduced, insurance underwriters and the general public were not aware of things like at-home care and adult daycare. Not only that, the general public was foreign to the idea of long-term care insurance in general. Just out of the blue, in the 70s, one day, this idea started to gain steam, but people did not know what to look for and how it was going to apply to them. So there's a lot of confusion about the industry. So society, as we noted, began to experience an increase in lifespan due to a bunch of new medical technologies that came on board. And due to this, people really started to see the value of standalone long-term care insurance. So the demand was built in for long-term care insurance, but were the policies designed properly to really meet that demand? Well, as most of you know, early adopters of technologies are usually figuring out the bugs, kinks, or flaws with the technology, and that happened in the long-term care insurance industry as well. So what are some of these flaws that popped up in the early standalone long-term care insurance policies? Well, for starters, they had really vague language that prevented some people from accessing their benefits. One example of the vague language is they did not define the activities of daily living, or ADLs, and that's a technical term. So there's 6 ADLs, and they are bathing, eating, toileting, transferring, continence, and getting dressed. And so imagine you can't perform 2 or 3 of those activities. You can't feed yourself, eat, you can't get dressed, and you can't transfer yourself. Well, you may believe that you qualify for your long-term care benefits. Well, unfortunately, in the early standalone long-term care policies, the language didn't define that, and there was a lot of contention about whether or not people were qualified to access those benefits. Today, in a properly structured long-term care insurance policy, look for language that says, if you cannot perform 2 of the 6 activities of daily living, then you can access your benefits for long-term care funding after the elimination period. That's an example of clear and concise language that was not available in early standalone long-term care insurance policies. So as I mentioned, problems began to arise when people who had been paying premiums for years went to access these benefits and some were denied. Now, one key thing to keep in mind is that in the 80s and early 90s, the underwriters for the insurance companies were not aware of the increase in medical costs and the coinciding increase in lifespan that would happen from a lot of the new technologies. And so when the policies were first put in place, they weren't really designed for the landscape of healthcare that was about to happen in America. So as people lived longer and medical expenses became more expensive, the insurance carriers realized how exposed they were to their risk. And a couple things happened. Some decided to pay out the benefits, others decided not to and to challenge the language. So I read an article earlier today where a lady, she actually paid into her long-term care insurance policy for $12,000. Those were the premiums she paid. And by the time she had finished accessing her policy and run its course, she had accessed $1 million worth of long-term care benefits. Now, I know I'm probably talking to a consumer, and I know you're probably thinking, that's how it should work. I pay $12,000, I get $1 million worth of benefits. And maybe in an ideal world, that would happen. But in reality, that's not cost effective for the insurance companies. And when they initially wrote these long-term care policies, they were expecting that $1 million in cost to be a lot lower because they did not see, again, the rise in medical costs for things like at-home care, adult daycare, nursing home. These costs weren't being realized in the 80s and 90s because those services weren't around. And also the coinciding increase in lifespan that happened due to those services. You may remember from a future broadcast that my grandma was put on hospice. That means you have 6 months to live. Well, due to the care in the nursing home, she lived 10 more years. So the insurance companies just did not see stuff like this happening. Now, the flip side of the coin is that insurance companies decided to not pay out certain benefits because they believe people did not have claims or justifiable claims for those benefits. For example, maybe they could not perform 2 or the 3 ADLs, and the insurance company said, well, you know what, that language isn't in our policy. What the policy says is you have to be in a hospital for a certain period of time in order to access your benefits. And so that alone could disqualify someone from not accessing their benefits. You may know someone who was shut out from access to their benefits in a similar manner. And one key thing to keep in mind is that it wasn't one person, it was many people who were affected in this regard. And those people litigated against the insurance companies who were rejecting their access to benefits. One perfect example of the fallout from this litigation is Genworth Financial and their recent downgrade. You may have heard of that in the news recently. And Genworth Financial has been forced to put aside $9.5 billion to take care of their benefits for their long-term care pool because they did not fully factor in how their benefits were going to be spread out over time, again, due to the medical costs increasing and lifespan increasing as well. So in response to this increased exposure, the insurance companies had to do something. And they couldn't just keep on paying out these benefits that were way more than the premiums they had received, essentially. And so what did the insurance companies do? Well, they went to the state insurance commissioners and they asked for rate increases. This is common with any insurance industry. If for any reason a book of business starts to be non-cost effective for the insurance companies, they typically go to the insurance commissioner and say, look, this book of business is not cost effective based upon how we wrote it. Therefore, we're going to need to increase premiums to cover this book of business on our books. A recent CBS News article highlights how Mass Mutual did this with the state regulators. They went to the state regulators and said, we want a 77% increase on premiums. 77%. Imagine that on your health insurance. Imagine that on your home insurance, your auto insurance. It would create a stir for anybody. You know, it would make sense in auto insurance if you got into a wreck or something like that, but otherwise, it's really just an alarming amount to pay. And one thing to keep in mind with regards to these standalone long-term care insurance policies is the policyholder does not get to return their premium unless they have a rider to return their premium. And so when faced with these 77% rate increases, the policyholders are really in a pickle if they don't have that return of premium rider on the policy. Just real quick to understand what a 77% rate increase looks like, let's say, just for round numbers sake, you were paying $3,000 a year for your standalone long-term care insurance policy. Imagine next year paying $5,300. That's huge. That's a lot of money, a lot more money to be paying. And so people who can't get a return of their premium are left with three not so great choices. The first off is pay the rate increase. That is going to be a lot of money for people who are close to or in retirement, and they may not be able to make up that difference. So let's say they can't make up that difference. The second option is you can keep on paying your current premium rate, but your benefits are going to be reduced accordingly. Well, people typically select their benefit pool in a relatively mathematical manner. And so they're not just guessing. They're not saying, maybe I need $100,000, $300,000, $1 million worth of long-term care funding coverage. It's more mathematic than that. So if you have to reduce your long-term care funding or benefit pool, then you're going to have to find out how to make up the difference in your reduction from your other assets. And option number 3 is just to walk away from the policy altogether. If you have a return of premium rider, you can get a return of your premium, but without that, those are going to be your 3 options. And the long-term care insurance industry really has taken a dramatic hit recently due to a lot of this bad PR. So in 2002, that's when the most policies were sold, and 750,000 policies were sold in America. In 2006, that number was down to 89,000 policies. That's almost 10% of what was sold in 2002. So one thing to keep in mind is just because the reduction in number of policies is happening, that doesn't mean we need less long-term care coverage. Quite the contrary, actually. So real quick, I'd like to open up the floor to the general audience if you have any questions, comments, or stories that you'd like to share. And moving along, I know you're probably sitting there and thinking, John, this is really doom and gloom. This is really dark stuff on long-term care insurance. Why would I even bother looking at a long-term care insurance policy? Well, first off, as I mentioned, the need for long-term care insurance is going nowhere. In 1960, 10% of Americans were retirement age 65 or older. In 2040, that number will be 20%. Today, we're spending 1.3% of GDP on long-term care funding. By 2050, that number will be 3%. As you can see, with increasing medical costs and increasing lifespans, there's going to be a greater need for long-term care funding, and people will have to have a solution in place outside of Medicaid. Unless that's your solution, then start figuring out a way how to become poor enough to qualify, because that's a really cumbersome process as well. So another reason to look at it is, I get it. A lot of this press, a lot of the things I'm talking about, a lot of the stuff I'm reading on the web, it's pretty negative stuff about the long-term care industry. But keep in mind that the headlines don't tell the whole story. Most of the headlines in the long-term care industry are rooted in the original standalone long-term care insurance policies that were not designed as well as current policies. And I want to do an analogous comparison to another industry. Look at cars today. Look at electric vehicles everywhere. Before 1960, we didn't even have fuel standards for our cars? If we talked about someone in 1920 about carbon emissions from our cars, imagine how they would look at us. Cars have come such a long way, and I use that comparison because the need for long-term care insurance is as essential as a car is to our society. It is the most cost-effective way to cover these costs. And the policies have evolved just like the car has evolved. And a perfect example are new hybrid life insurance policies that have a long-term care rider in place. What that long-term care rider allows you to do is access the death benefit in life when you qualify for long-term care needs. And I'll be going over those policies on the next broadcast. So the current stats say that 70% of us are going to need long-term care funding at some point during our life. So I highly recommend that you talk to a licensed insurance professional about this topic, and I have a couple questions for you to think about and go over with them. So when you look at some policies with an insurance professional, ask them, is this an indemnity or a reimbursement plan? So an indemnity plan is going to say you, the policyholder, get $2,000, $5,000, $10,000 per month out of your benefit pool to take care of your long-term care needs. And you get that until you use up all of your benefit pool. Now, a reimbursement is where you or someone else pays for your long-term care expenses and then reimburses those with the insurance company. Personally, I've already been through long-term care funding or the long-term care dilemma with a family member. It is holistically taxing on everybody who loves that individual. And I just don't want my people dealing with the reimbursement aspect. They're already going to be dealing with enough. It's up to you, but I personally would choose an indemnity plan, which is better suit my needs and interest. So another thing to think about is the policy that you're looking at tax qualified? So some of these life insurance plans have insane tax favorable options that you cannot find in other plans, and these help you grow money for supplemental retirement income. Let's say you don't use this hybrid policy for long-term care funding. Well, it can be used for other purposes and it has very tax favorable growth mechanisms in place as well. So really make sure you understand all the policies out there and you decide which one works right for you. So another thing to think about is how much coverage do you need to supplement based upon your current portfolio. So what we do at the Lyman Group when we meet with a client is we sit down and we get to know two things. We get to know their health background, their family history, how long have your family members lived, are there any outstanding health conditions, and we also sit down and look at a personal financial statement, which has all the assets on one side and liabilities on the other side. And what this gives us a chance to do is to see their whole financial picture today and how it's going to move forward in the future. Then what we do is we analyze how that portfolio is going to be hit by taxes, because whenever you remove your money from your investments, you're going to take a tax hit. And so at that point, we see what's left over, and then we look at what's left over for long-term care funding if you need it. From there, we can identify how much is on the table and the difference that you need to make up with a long-term care insurance policy in order to feel properly covered and make sure that you're taken care of. So another thing to think about, and I covered this earlier, is does the policy include a definition of the 6 ADLs, or activities of daily living? And does it also include terms for what happens if you cannot complete 2 out of the 6 ADLs? What I recommend you look for is language that sounds something like this. If you cannot complete 2 out of the 6 activities of daily living, then you qualify to access your death or your benefits for long-term care funding after the elimination period. And I've mentioned this a couple times, but it's really something to make sure you're looking at, because some insurance professionals will only focus on certain opportunities and leave other ones in the dark. But are you aware of tax favorable life insurance policies that could be more cost effective than standalone long-term care insurance as well? And if you're not covering that with your insurance professional, I would highly recommend you bring that up and ask them to pull some numbers on your behalf, just so you can compare it side by side and get a greater understanding of the offerings that are available to you. All right, guys, I'd like to open up the floor one more time to any questions or comments you may have. And if there are none, I really appreciate you joining me today. We are through the tough part of long-term care insurance in the industry. If you're watching this after the video and have questions, please let us know, because this is a really big issue with a lot of our clients today, and that's why we're spending so much time covering long-term care insurance. Next week I'll be coming back and looking a lot more in depth into those hybrid life insurance policies with the long-term care insurance riders, and really highlighting some benefits that separate those policies from the old standalone policies of the past. Thanks a lot, guys, and I look forward to seeing you next week.